Is the Bandhan Life iInvest Advantage Plan truly the smart way to build long-term wealth or just another ULIP dressed in advantageous packaging? Let us find out the answer to this question through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this plan, let us first understand a few basic details about it. So, this is a unit-linked, non-participating individual life insurance savings plan. Some of the key features of the policy are: to match your financial goals, there are multiple investment strategies available, and you also get access to a diverse range of funds tailored to your investment profile. And you also get loyalty additions starting from the 15th policy year to enhance your overall returns. There is also refund of mortality charges at the time of maturity, and you're eligible for tax benefits as per the prevailing tax laws, and there is flexibility to switch between funds as per market conditions or changing goals, and you have the option to receive the maturity benefit in installments through the settlement option. These are some of the key features of the plan, and there are benefits like death benefit, maturity benefit, return of mortality charges, and loyalty additions. So these are some of the benefits available, but still, as a unit link policy, they charge charges like fund management charges, mortality charges, discontinuance charges. So these charges are applied throughout the policy term, reducing your invested amount and thereby lowering your overall returns in the long run. So we need to consider this as a drawback as well. So some of the advantages of investing in this policy are: you get to switch from portfolio strategies, which is permitted once every policy year at any time during the policy term without any charge. And the policyholder can make top-up premium payments to enhance the fund value, and partial withdrawals from the fund value are allowed after completing the first 5 policy years. Under the settlement option, the maturity benefit can be received in structured installments over a chosen period, which is not exceeding 5 years from the maturity date. So this plan allows flexibility to modify your premium payment term, reduce your premium, and switch between funds. You can also change your premium allocation proportions across various segregated funds as per your investment preferences. So these are some of the advantages of the policy. However, there are some disadvantages, like there are no policy loans permitted under this plan, and no liquidity is provided during the early years of the policy. The sum assured might be inadequate to meet significant financial needs as well, and the investments are based on the net premium, which is calculated after deducting applicable charges. So these are some of the drawbacks that we need to consider before deciding to invest in this policy. Now, as we have a basic idea about this policy, let us move on to the analysis part of the video, where we are going to conduct an IRR analysis based on the benefit illustration given in the policy brochure to help us make a more informed decision. But if you still want to know more about certain aspects of the policy in detail, you can refer to the policy brochure. Let us assume, for a calculation purpose, that a 35-year-old male has purchased a plan with a sum assured of 10 lakh, a policy term of 20 years, and a premium payment term of 10 years, paying an annual premium of 1 lakh. Assuming consistent premium payments, the policy brochure projects the potential fund value at 2 assumed growth rate like 4 and 8%. These projections are purely for example purpose and not guaranteed, as the actual maturity value depends on multiple factors, including fund performance and market conditions. So at 4% returns, the fund value is 14.62 lakhs, resulting in an IRR of 2.47% as per the policy's maturity calculator, which is even lower than a basic savings account interest rate. At 8% returns, the fund value rises to 26.51 lakhs, giving an IRR of 6.38% as per the policy's maturity calculator, which is roughly comparable to or lower than the returns from a bank fixed deposit. Despite being marketed as a long-term market-linked investment, the plan's returns remain modest, limiting its wealth creation potential. While equity-oriented market investments tend to generate better long-term growth, this plan falls short of delivering meaningful value. In conclusion, subpar returns, restricted liquidity, and an inadequate sum assured makes this policy unsuitable for inclusion in your investment portfolio. portfolio. So now, as we know that this policy does not give us the desirable outcome that we need, let us move on to a comparative analysis where we are going to take up an alternative approach, where instead of combining insurance and investment like how it is done in Bandhan policy, we are going to separately invest in insurance and investment just to see whether that can give us efficient and better results. So here, for life purpose, we have purchased a pure term life insurance policy. So we are going to take up similar or same parameters from the previous example for a fair comparison. So this policy with a sum assured of 10 lakhs pays an annual premium of 7,500 rupees for 20 years with a premium payment term of 10 years. So this leaves us with 92,500 rupees each year to invest based on a risk appetite. So if you want to take a low risk approach, you can invest the remaining amount in a public provident fund (PPF), where the 92,500 rupees will have a maturity value after 20 years for 27.29 lakhs, delivering an IRR of 6.58%. Interestingly, this is comparable to the 8% scenario of the Bandhan policy, yet PPF is a more safer government-backed debt instrument. But if you want to take a high-risk approach, you can invest the same amount in an equity mutual fund where the pre-tax maturity value could reach 56.46 lakhs. After accounting for capital gains tax, the post-tax maturity value stands at 50.72 lakhs, yielding an impressive IRR of 10.74%. So equity mutual funds, while market linked, provide superior risk adjusted returns, liquidity and freedom from lock-ins. If you want to know how we have calculated tax for equity mutual fund, we do have presented a small tabular column on this aspect on the screen for your easy reference, which you can pause and see. So in contrast, this policy lacks both flexibility and high return potential. Hence, separating insurance and investment through a pure term plan plus tailored investment portfolio proves to be a far more efficient and rewarding strategy for long-term financial growth. Then what is the final verdict? Is investing in the Bandhan Life iInvest Advantage plan worth it or not? So this is a standard unit-linked insurance policy which combines life insurance coverage with market-linked investment opportunities. So you pay premiums for a limited period and at maturity you receive the fund value along with return of mortality charges and loyalty additions. However, a deeper evaluation uncovers major shortcomings, primarily its low return potential. The high charges associated with this ULIP significantly erode investment growth, leading to subpar returns and restricting long-term wealth creation, and it also has a high agent commission. Moreover, the inadequate sum assured further diminishes its value as a comprehensive financial solution. By blending insurance and investment, the plan ultimately compromises on both protection and performance. A more efficient approach would be to separate insurance from investment, safeguard your family's financial security through a pure term life insurance policy which offers substantial coverage at a minimal cost. Then direct your savings into investment products that align with your risk appetite and financial goals such as equity or hybrid mutual funds. To build a robust and inflation adjusted corpus, your investment portfolio should include higher yielding instruments that match your long-term objectives.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.